Welcome back to Bloomberg's Masterclass. The Merrill Lynch Bank of America deal was announced in September, but by the end of January, John Thain was gone. Did Ken Lewis make the right call? We spent the day with the capitalism class at the University of Florida's Wharton Business School. Students and teachers both weighed in on one of the biggest business stories of the year.
Fair to say that this isn't necessarily the outcome that I would have expected when I took this job.
Why did Ken Lewis fire John Thain so early in the marriage? And was it a good idea? It's very clear that if he was going to be a scapegoat, and there were a couple of things that he was being, people were pointing to as far as his office, which, by the way, may have been contracted earlier. It was those bonuses that were paid in December instead of January. What I really think drove that were the losses. I think the losses that John Thain didn't have a lot to do with other than he came in with a spectacular record, and not only at Goldman Sachs, but what he did at the New York Stock Exchange. I mean, he was Mr. Fix-It, and he has a lot of talent. But more importantly than that, I think there is obviously a challenge on keeping the financial advisors. They're entrepreneurs in a way. They all have their own book. In fact, I happened to deal with Merrill, and I can recall what they were like 15, 20 years ago, how they operated, and how now was basically one person. Now you have a team in most cases, and they're really outstanding teams. 3 or 4, 6 or 8, whatever. And it's almost like you got your own little private group. And so they're really doing that right. And I think there's a good chance that part can grow and prosper. And what I'm really more worried about is the investment banking side. To make this thing really work, I think you need to have the investment bankers, the commercial bankers, somehow get on the same page. And I have been told that a good number of the investment bankers are sort of going the regional or the startup, and in fact some have enough in the bank that they're going to take a 6 or 12 or 18-month sabbatical, figure out what the financial service industry is going to look like. I think we are at a point here that it is, it's like walking, on sand. I mean, if you've ever been in a riptide, or you've been out on the beach. I grew up in Michigan, and you're standing there, and you're standing, but the sand's moving from underneath. It's a funny feeling, and I think that's where we are. I think that Thain, if he would have stayed around, I think he really would have been a presence that would have been very helpful in keeping the investment bankers and that whole part.
The CEOs had 2 bosses, their duty to the shareholders of the company, as well as the pressure that was put on them by the regulators and government officials. And I was hoping that maybe you could give us some insight into what you think the conflict will result in going forward.
You're in a war, and your boss, who's a key regulator, is telling him, for the sake of the economy, you got to go through with it. And then maybe there were some assurances given. But you've got, that's probably one of the really toughest problems that's going to have to be resolved out of this. I mean, I just don't think there could even be a waiver, to be honest. I mean to the disclosure issue to shareholders.
What do you think would have happened if the deal did not go through, if the merger wasn't executed?
My view is if that merger had been stopped right at some point, the government would have had to step in some form, either with another party and guaranteeing a certain amount of liability. I mean, Lehman Brothers was a real shock. Not that a large institution was allowed to fail, but the ramifications it had on the marketplace. I mean, even sophisticated people on Wall Street, et cetera, didn't realize, I mean, some did, but a lot of them didn't realize how far down that went.
When Bloomberg's Masterclass continues, Win Smith sums up what life at Merrill Lynch was like under former CEO Stan O'Neill. Having left Merrill Lynch earlier this decade and gone back to private business, Win Smith has a unique vision of the world, which once consumed most of his time. In our final segment of Bloomberg's Masterclass, Smith has some advice for the students at the University of Florida regarding his old Wall Street colleagues.
Yeah, the real world makes real things, and it gets paid a reasonable amount of money, okay? Look, I spent 30 years on Wall Street, and I loved every single second of it. I do it again. I think the vast majority of people in the firms I dealt with have high ethics, really enjoy what they're doing, really think they're doing the right thing for society. But the reality is, New York City and London, aren't the rest of the United States. And when you get out into a small community like the one I live now in Warren, Vermont, you realize that, people are very happy they get by earning $50,000, $60,000 a year. In many ways, they have a different set of values. They're looking at the environment differently, the economy different. They're very much into locavore food. And, they're living a very healthy, life. They're intellectually smart. Some of the people I see there are as smart as anybody I've seen on Wall Street, but they've just, chosen to do things very differently. And I think, the real world outside of the major New York and California areas are very different. And what I think you're seeing right now is I think you're seeing anger. And that's why you're seeing a populist movement, because people don't understand how their lives have been affected by these financial wizards and, how they can't get access to credit and what's happened to their 401k and their IRA. And now they can't afford to retire or send their kids to school. So that populist anger, in real America, I think is out there, and what I hope is going to happen is it won't result in bad regulation for the wrong reason. But there's going to be great pressure to get those guys that made this problem.
It's my understanding that Merrill offered both Goldman and Bank of America a 9.1% stake. What is your opinion if that would have happened? Would Merrill been able to survive?
I mean, there certainly could have been, some different ways that Merrill could have raised capital. It had to raise capital at that point in time. Again, I think the strategic fit potentially of Merrill and Bank of America is very strong. Merrill considered a lot of things over the years. I always remember a comment that Walter Wriston made, to digress for a second, when he was asked back in I think it was the mid-'70s or early '80s after we came out with the CMA account. And when there was a debate about Glass-Steagall, and somebody asked him at a conference, what's your vision of the future bank? And his answer was, it already exists, and it's called Merrill Lynch. And so over the years, there have actually been a lot of people interested in Merrill Lynch. We came very close to merging with Chase. And that actually could have been a great strategic fit. It didn't happen for probably the normal reasons in a merger. Not sure what the leadership team was going to look like, whether it was going to be Chase Merrill or Merrill Chase. There were discussions with American Express a couple of times over the years, and we always determined, at the end that we would rather be independent and we'd rather be the acquirer instead of the acquired.
That wraps up this edition of Bloomberg's Masterclass. Thanks for joining us as we saw firsthand what future decision makers and Wall Street pros thought about Bank of America's Saturday morning decision to buy Merrill Lynch. Until next time, I'm Carol Biaggi.